If you clicked on this video, you only want one thing. And I plan to deliver on that exact thing that you want, which is to genuinely make money trading. My name is Nick and I've been trading live in front of thousands daily for a little over a year right now. And if you scroll through my hundreds of YouTube live trading streams, you'll see that I have an 80% calculated lifetime win rate. The reason I say this is because I respect your time. I don't want you to spend time and hard-earned money listening to someone who doesn't have the results you want to achieve. So if your eventual goal is to make somewhere in the ballpark figure of $100,000 to $200,000 per month, like these, and consistently do it month on month on month, then this video is everything you need because I'm not going to hold back anything. When I first started trading, I learned simple support and resistance to get started. Why? Because that's what every single YouTube video and Baby Pips video said. So of course, as a young, inexperienced trader, I went on TradingView, deposited $1,000 into a broker, and started drawing boxes on the chart. And like 99% of people who watch this video, yes, I busted the entire account. So in this video, I'm going to give you the better alternative to support and resistance trading. Trading like the banks is a complicated concept, but I'm going to break down my trading strategy into 4 simple steps. Keep in mind, this is one of my many strategies I use on stream to attain my consistent 80% win rate. But understanding this strategy acts as a base for all future institutional trading strategies that you will use. So the question is, how do you trade like the banks? To do that, you need to understand these few things. Number 1, liquidity. Understand the key areas of liquidity. Liquidity is where people place their stop losses, and these are common areas like your swing highs, swing lows, support, and resistance areas. In order to move the market, the banks need to have enough orders in the market to push price in a certain direction. If price wants to go upwards, we need to have more buy orders than sell orders. However, price doesn't just go up in a singular straight line, and these areas of liquidity are used as retracement points for price to collect more orders to continue moving the market in its intended direction. For example, here we have the gold chart. We can see that after price moves up super aggressively, price retraced. And where did price retrace into? It retraced into an order block, which is also together with a fair value gap, to collect more buy orders at this area before continuing to pump higher. This order block is an area of liquidity where there are many buy orders sitting and waiting to be collected, and thus the market comes back into the order block over here to collect these orders to continue pushing higher. Another example on gold as well. We can see that before pushing higher, price came into these equal lows, taking them out before pumping even higher. These equal lows are basically areas of liquidity because many people have their stop losses placed over here. And as mentioned earlier on, the banks love to take out concentrated areas of sitting orders that haven't been collected to continue to move the market in its intended direction. In this specific example, it's towards the upside. Number 2, order blocks. An order block is identified by a candle that marks a change in the market's direction. For example, a bullish order block is the candle that created the lowest point in price before creating a higher high, like this. The converse is true for a bearish order block where it is identified by the highest point in price a candle has created before creating lower low. It is important to note that for an order block to form, there needs to be a break of a structural high or low in order for it to be valid. For example, in an uptrend, price creates higher highs and higher lows. And at this instance, price hasn't broke past the previous structural high. So therefore, we have to wait for price to break past the previous structural high before we can identify a bullish order block over here. The opposite is true for the bearish scenario. Number 3, market structure. More specifically, break of structure and change of character. This will be used for your confirmation, so pay close attention. A break of a structure, or BOS, is when price pushes past previous structural points. Now, in an uptrend, a BOS happens when price breaks past the last higher high. The next part here is key, so pay close attention. You will need a body candle close above the last higher high to be considered a valid and strong break of structure. On the other hand, in a downtrend, a BOS happens when we break past the last lower low with a body candle close below the break of structure level. Now, for a change of character or chokchi, this is when an uptrend or a downtrend makes an initial change. If we are in an uptrend, then the most recent high low breaks through to create a brand new lower low. This is when we can identify a bearish change of character. However, if we are in a downtrend and the most recent lower high breaks through to create a brand new higher high, then we have a bullish change of character. Now that you understand these concepts, here is how to put it all together in a singular strategy. Step 1. Identify your market structure and trend on the 4-hour and the 1-hour time frame. If you see higher highs and higher lows being created, we have an uptrend. If you see lower highs and lower lows created, we then have a downtrend. The second step is to mark out your 4-hour and the 1-hour order blocks that are closest to the current market price. This can be both bullish or bearish order blocks. Based on the trend that you've identified in step 1, the order blocks can be either pro-trend or counter-trend. Now, I understand why some of you guys here may be confused as to why I'm looking for a counter-trend order block. So let me explain. Counter-trend order blocks can be used in 2 different scenarios. Number 1, these are areas we can look at to take profit, as we can expect some form of resistance when price approaches these order blocks. This is because if we see an order block that hasn't been tested before, likely scenario is that once we come into the order block, we will see some sort of a reaction from the order block itself. Number 2, counter-trend trades can be taken from these counter-trend order blocks to ride the wave towards our pro-trend order blocks for a quick scalp. Remember, if you're going counter-trend means the trade is lower probability, and therefore a quick scalp would mean that we are going in and out of the markets fast in case the market reverses. Step 3, time frame alignment. If you're using a 4-hour order block, use the 15-minute time frame for confirmations. If you're using a 1-hour order block, then use the 5-minute time frame for confirmations. Just keep this in mind as it's very important for the strategy. Step 4, confirmations. Now, on your confirmations time frame, do look out for a chokchi at your higher time frame order block. If the higher time frame order block that you have marked out is pro-trend, which means going along with the trend, then a single chokchi is enough of a confirmation to execute your trade. However, if your order block is counter-trend, then you need a change of character and a further break of structure to confirm the validity of the trade. Other factors like liquidity sweeps and lower time frame order blocks can act as an extra confluence to give you more confidence in your trade. Simple enough? Let's dive into some examples of the trades that I took live on stream using this exact strategy. So, step 1, look for the overall market structure of the pair we are trading. Here we have the 4-hour chart on gold. The overall market trend, as you can see, is bearish because of the lower highs and lower lows created. At this point, we move on to step 2. I marked out a bullish order block which I can use to take a trade off. If you're confused, let me recap on how to find an order block. Identify the last candle that created the lowest point in price before breaking past the previous high, which in this case is the candle over here. Step 3, time frame alignment. As mentioned before, if we are at the 4-hour chart, we are looking for the 15-minute confirmation. Here, I dropped to the 15-minute time frame and saw that we had a liquidity sweep with a bullish change of character, or better known as chokchi, indicating that price is going to push higher. We then broke structure to the upside. This was my confirmation for the counter-trending trade, which is step number 4. I took a buy here with my stop loss set below this swing low. Now, if price decided to break past this swing low, price would have turned bearish on gold as we would have created a lower low and thus invalidating the trade. Take profit wise, target the untested 15-minute bearish order block. As mentioned in step 2 earlier on in the video, untested order blocks can be used as areas to take profit, as these areas are main points of interest where price may actually retrace from. As you can see, price ran 120 pips to the upside, taking heavy partials along the way. So if you're a complete beginner, 120 pips is $1,200 per lot in profit. So let's go ahead and do a quick recap on why this trade play out. Step 1, look for your overall market structure. Step 2, look for your 4-hour or your 1-hour order block. Step 3, since in this chart we are looking at the 4-hour time frame, we look for the 15-minute confirmations. Step 4, look for a change of character in the direction of the trade that you want to go. And in this case, we're looking for buys as we're going counter trend into the untested bearish order block. Now, let's dive into the next example using the same exact steps. Step 1, we look at the 4-hour chart on the GBP/JPY. Overall, there was an uptrend, but focusing on the most recent leg of price over here, we did see that price started to show bearish intention with this change of character formed on the 4-hour time frame. So I marked out my bearish order block over here and a potential target forming at this swing low. Then I dropped down to the 15-minute time frame to look for my confirmations. Right here, we created a change of character or a chokchi with a strong bearish intention lower. In the process, a small fair value gap was created. After price retested the bearish fair value gap, which was my confirmation, I entered a sell over here once price broke below the change of character level. Now, you may ask, Nick, why did you enter off the fair value gap but instead wait for price to go below before entering. Since the change of character did not create a body candle close, it indicated to me that there was a lack of bearish pressure, and thus I waited for price to go even lower past the Chokchi level, creating a brand new low. This forms a bearish BOS, which then confirmed my sell bias in order to take this sell trade. Stop loss placement will be above the 15-minute swing high, because if price breaks past the 15-minute swing high, the trade becomes completely invalidated, since this is a bullish signal. My take profit was placed at the 4-hour swing low. Since we are bearish on the 4-hour time frame, we should expect price to continue breaking the 4-hour lows to continue the bearish trend. The reason why I didn't place my take profit at a lower price is because I do expect price to provide some form of a retracement after breaking the swing low, as price will need to gather more sell orders to continue pushing lower. Based on the first thing I mentioned in this video, liquidity, I would assume that price would have to retrace around this area. If price decides to retrace, then our profits would have been secured at 100 pips anyway, which is good enough for me. Now, if I was a complete beginner and put into your shoes, I'll be totally excited to try this new strategy on the markets immediately to see whether this master is full of shit or not. But hold your horses. In order to trade consistently in the markets, it's not as simple as having one single winning strategy and doing it over and over again. This is the portion of the video which most people skip out on, but it's literally the other half of the puzzle that you need filled in order to be genuinely profitable in trading. If you've never watched my live stream where I take trades live and manage it in front of an audience of 20,000 people daily, then you're in for a treat, because I'm going to summarize the key trading principles you need to follow today if you want to become profitable with this strategy. These exact principles are the ones which I use live in front of everyone while trading, and I can comfortably say I have historically had an 80% win rate in front of an audience for an extended period of time because of these trading principles. Now, the first important caveat that you need to follow is this: follow the trading plan regardless whether you think it is wrong or not. I see complete beginners think that they are smarter than the trading plan set out for them. They augment the TP, SL, change the entry criteria, and do all sorts of funny things. The late Beethoven mentioned, and I loosely paraphrase because I can't remember the exact quote. The first step of learning music is copying everything. After we have mastered it, the second step is to forget everything. What he is trying to say here is that you have to copy everything 100% to the T in order to understand how this strategy works to its deepest core. The entry criteria, the biases, the price action, and everything in between. Once you're able to understand everything on a deep level, you should then iterate it and slowly change parts of the strategy to suit you better. Now, if you're a complete beginner with no trading knowledge and understanding, then follow this full trading plan without deviating. You will for sure get a better result than thinking that you're smarter than the trading plan itself. The next caveat, have a risk management plan. If you don't know, most millionaire traders risk only a small percentage of their account per trade, somewhere in the range of 1 to 5%. As a beginner trader, I can understand the allure of doubling your $1,000 accounts in a day, but that's not how you really get good at trading. You will have to trade with a deep understanding of how risk management works, which in simple terms is loss management. As a beginner, you think, how much can I win from this trade? As you mature, the mindset will shift to, how much can I lose from this trade? And base all your trading actions on that. If you want to understand more about risk management, you can check out the video over here. Thanks for watching all the way to the end of the video. If you'd like to see more videos on different beginner-friendly strategies, then check these videos out. If this video does benefit you in any way, shape or form, then consider leaving a like on this channel here and share to someone that may actually benefit from this. Thank you so much for your time. I hope that this was a positive ROI on your attention, and I hope to see you in the next one. Nick signing out.